The rules behind every financial statement are hiding in plain sight, and most people never read them. Going concern warnings, revenue that isn't really revenue yet, leases that used to vanish off the balance sheet, lawsuits worth millions of dollars that never touch the numbers. Behind each one is a specific GAAP standard or SEC rule doing the work. In the next few minutes, I'll break down the ones that matter the most in plain English. Let's get to it. Buried in the footnotes. A company can be forced to admit it might not survive the year. It's called the going concern warning. Every reporting period, management has to step back and ask a hard question. Is there substantial doubt about our ability to keep operating for one more year? Not forever, just the next 12 months after the statements are issued. If the answer is yes, and their own plans can't reliably fix it, that doubt has to be disclosed. Here's the counterintuitive part. Even a company with real debt still prepares its statements on a going concern basis, right up until liquidation is imminent. So the warning sign isn't in the numbers, it's in the words. Next time you read a set of financials, check the going concern footnote first. It tells you what the balance sheet won't. New accounting rules drop every year, and I don't know is not a defense. They're called Accounting Standards Updates, or ASUs. Every time the FASB changes GAAP, it issues one, and they don't announce themselves on your desk. The pros treat staying current as a process, not luck. Staying informed on what's issued, figure it out even if it applies to you, and whether it's material. I'll figure out if it even applies to you and whether it's material. Evaluate your options and your adoption date. Benchmark your disclosures against your peers. Track it, update, and adopt on time. Miss an effective date, and you're not just behind. You may be out of compliance. Think about your own shop. Do you have a system for catching new standards, or are you hoping someone forwards the email to you? A huge share of every financial statement isn't measured, it's estimated. That surprises people outside the profession. This allowance for doubtful accounts, an estimate, Goodwill impairment, warranty reserves, pension obligations, the useful life of an asset, all estimates, which means judgment, and judgment leaves room for bias. Push an assumption one way and profit goes up. Push it another way and a liability quietly disappears. That's exactly why estimates draw so much scrutiny from auditors and regulators. That's where the numbers are the softest. Next time you review a statement, ask which figures are hard facts and which are somebody's best guess. You can't just switch accounting methods because you like the numbers better. GAAP doesn't work that way. Changing an accounting principle, say how you value inventory, isn't a free choice. You have to show the new method is preferable, not just convenient. And here's the part that trips people up. In most cases, you apply it retrospectively. That means going back and restating prior periods as if you always use the new method, plus disclosures explaining the change and why. It's a high bar, and it's on purpose to keep companies from cherry-picking methods to smooth results. Think about a change you've considered. Could you actually defend it as preferable, or does it just look better? Not every accounting error gets fixed the same way. The size of the mistake decides how loud it is. Here's a split. When an error is material to prior periods, you restate those prior statements. That's a big R, restatement. It's public, it's disclosed, and it says the old numbers couldn't be relied on. When the error is material only to the current period, and you can correct it in the current period, a little r. Quieter, but still a correction. Getting that call wrong is its own problem because it points straight at a breakdown in internal controls. Think about your last close. If a prior year error surfaced today, would you know which path it takes? Booking revenue isn't as simple as we got paid. There's a 5-step model behind every dollar. It's ASC 606, and it's changed almost everything. Step 1. Identify the contact the contract with the customer. I'll say that again. Step 1, identify the contract with the customer. Step 2, identify the performance obligations, what you actually promised. Step 3, determine the transaction price. Step 4, allocate that price across each obligation. Step 5, recognize revenue only as you satisfy each one. Cash in the door doesn't mean revenue earned. Getting the timing wrong and you've misstated your top line. Think about your own controls and your own contracts. Do you know exactly what each promise or when each promise is satisfied, or are you recognizing it on gut feel? For decades, companies kept billions in leases off the balance sheet. That loophole has closed. That standard is ASC 842. The old rules let operating leases live in the footnotes, real obligations invisible on the balance sheet. Now almost every lease longer than a year shows up. You record a right-of-use asset for what you control and a lease liability for what you owe. Suddenly, a company's true obligations are right there in plain sight. It didn't change the economics. It changed the honesty of the picture. Think about your own lease portfolio. Is every commitment on the balance sheet where it belongs? When one company buys another, you don't just add the two balance sheets together. GAAP requires the acquisition method. First, figure out who the accounting acquirer actually is. It isn't always who wrote the check. Then pin down the acquisition date. Then measure everything acquired, assets, liabilities, at fair value, not the seller's old book value. Whatever you pay above the fair value becomes goodwill. Pay below it, and you book a bargain purchase gain. Get the fair values wrong, and every number after the deal is off. Think about the deal you've seen, or deals you've just seen. Was the purchase price really landing where it should on the books? Goodwill can sit on the balance sheet for years, until one day it can't. Here's how the test works. Goodwill isn't amortized off a little each year like other assets. Instead, it's tested for impairment. You can start with a qualitative check. Is it more likely than not that goodwill is impaired? If that raises a flag, or you skip straight to it, you run the quantitative test and compare fair value to carrying value. If fair value falls short, you write goodwill down, and that hit runs through earnings. It's often the first sign the market soured on an acquisition. Think about the goodwill on your books. When did you last really pressure test it? Build software for your own company, and part of the cost gets expensed while another gets capitalized. The line is all about timing. Under the internal use software rules, it comes down to the stage of development. The early planning stage, research, evaluating options, gets expensed as you go. Once you're actually building it, the application development stage, those costs get capitalized. Then once it's up and running, you're back to expensing the upkeep. Draw the stage line wrong, and you've either overstated an asset or understated your expenses. Think about your last software project. Did you know exactly when capitalization should have started? With software you plan to sell, one milestone decides whether costs are an expense or an asset. It's called technological feasibility. Before you reach it, all that development cost is research, expensed as incurred. Once the product is technologically feasible, you can start capitalizing. And capitalization stops the moment the product is, in the standards words, available for general release to customers. Miss where that line falls and your costs land in the wrong place and in the wrong period. It's a narrow window and it matters. Think about a product you've shipped. Could you point to the exact moment it crossed into feasibility? The moment an asset is truly held for sale, you stop depreciating it, even before it's sold. But you don't get to flip that switch whenever you want. The asset has to clear 6 specific criteria. Management commits to a plan. It's available for immediate sale as is. There's an active program to find a buyer. The sale is probable within 1 year. It's priced reasonably against fair value. and significant changes to the plan are unlikely. Meet all 6 and the accounting changes, including that you quit depreciating. Think about an asset you're planning to sell. Does it actually meet all 6 or just the first one? A company can be getting sued for millions and still not put a single dollar on the balance sheet. It comes down to 3 words. When a loss is probable and you can estimate it, you record a liability. When it's only reasonably probable, you don't record it, but you have to disclose it. And when it's remote, you generally do nothing at all. That's 4 words, but that's 3 situations. So the footnotes can be hiding a lawsuit that never touches the numbers. That's not a loophole. It's contingency rules working as designed. Think about the disclosures you read. Are you checking the legal footnotes or just trusting the balance sheet? Sign a guarantee, and you may have just created a liability you didn't record. Most people miss this one. Under the guarantee rules, when a company stands behind someone else's obligation, that promise can carry a real accounting weight. At inception, you may have to recognize the liability for the fair value of the guarantee before anyone has ever called on it. Then there are disclosures, even when you think nothing will come of it. A guarantee feels like a favor. On the books, it's a commitment. Think about the guarantees your company has made. Are they sitting in the notes or invisible entirely? A derivative can be worth a fortune or worth nothing, and the difference is just where the price sits today. Let's demystify the jargon. A derivative's value comes from something else, a stock, a rate, a commodity. If exercising it right now would make money, it's in the money. If it's a wash, it's at the money. And if it lose money, it's out of the money. Companies use them 2 different ways: to hedge, to reduce risk, or to speculate, to take it on. Same instrument, opposite intentions. Think about your company's derivatives. Do you actually know if they're managing risk or creating it? Without hedge accounting, protecting your company from risk can make your earnings look wildly unstable. Here's the mismatch. Say you use a derivative to hedge against real business risk. Normally that derivative gets marked to market every period. Big swings hit earnings now. But the thing it's protecting might not move until later. So the hedge looks like chaos, even though it's doing its job. Hedge accounting fixes the timing, matching the gain or loss on the hedge to the item it protects. The catch? You have to formally designate it and prove it actually works. Think about your hedges. Are they documented tightly enough to qualify or exposed to a nasty surprise? Blockchain isn't just for crypto traders. It's quietly reshaping what accountants can trust. Strip away the hype. A blockchain is a shared ledger copied across many computers instead of held by one. Every entity is agreed on by the network, and once recorded, can't be quietly changed. For an accountant, that's the interesting part. A record that's tamper-resistant and visible to everyone is a record you spend less time confirming. It won't replace your judgment, but it could change how much of the audit is just proving nothing was altered. Think about your own work. How much of it is verifying that records weren't tampered with? For years, there were no real rules for crypto on the books. Now there are, and they changed the answer. This is one of the newest standards. Under the FASB's update, ASU 2023-08, qualifying crypto assets are now measured at fair value. That's a big shift. The old approach treated them like intangible assets, written down when they dropped, never written back up when they recovered. Now the gains show up too, right alongside the losses, each period. It applies for fiscal years beginning after December 15th, 2024. Think about any crypto on your balance sheet. Are you ready to mark it to fair value, up and down? 2 laws from the Great Depression still govern nearly everything public companies disclose today. Start with a pair. The Securities Act of 1933 governs new securities. What you tell investors when you can first sell them. The Securities Exchange Act of 1934 governs everything after. Ongoing reporting once you're public. Layered on top, Regulation Fair Disclosure, which bans quietly tipping off select investors, and the Sarbanes-Oxley, or SOX, born from Enron, which put executives personally on the hook for the numbers. Old laws, but they shape everything you'll ever read. Think about the filings you rely on. Do you know which law is actually forcing each disclosure? A giant company can look like one business on the outside and be 5 very different ones underneath. Segment reporting exists to reveal that. Under ASC 280, companies have to break results out by operating segment. And the test isn't how you're organized on paper. It's what your chief operating decision maker actually looks at when allocating resources and judging performance. Whatever they use to run the company is what has to be disclosed. It stops a strong division from hiding a weak one inside a single blended number. Think about a company you follow. Do you know which segment is really carrying the results? Remember GE? Some news is so important, a public company can't wait for the quarterly report to tell you. That's what Form 8K is for. It's the current period, or the current report, filed when something material happens between regular filings. A major acquisition, a bankruptcy, losing your auditor, a CEO departure, stuff like that. And the clock is tight, generally 4 business days from the triggering event. It's how the market learns the big stuff in near real time instead of months later. Skim a company's 8K history and you're reading its unfiltered timeline. Think about a company you track. When did you actually last read its 8K filings? The glossy annual report companies mail out isn't the one that really matters. This one is. It's the Form 10K. It's the comprehensive annual filing every public company submits to the SEC. Audited financial statements, the real risk factors, the business described plainly, management's own analysis. No marketing gloss. It's built for the SEC, not the mailing list. Large companies face tight deadlines to file it, and the SEC reviews it. If you want to actually understand a company, this is the document. Think about the last company you researched. Did you read its 10K, or just the highlights someone summarized for you? The most revealing part of a financial report often isn't the numbers. It's management explaining them. That section is the MD&A. Management's decision and analysis is where leaders explain in their own words what drove the results. Why revenue moved, how liquidity works, what the critical estimates really depend on. The SEC wants the story told through management's own eyes, the good and the bad, and they watch it closely for spin. Done right, it's the closest thing to management talking to you straight. Think about the reports you read. Do you study the MD&A or skip to the tables? Adjusted earnings can make a losing company look like a winner, and the SEC is watching closely. These are non-GAAP measures. Things like EBITDA, or adjusted net income, numbers company build by stripping items out of the official GAAP results. Used honestly, they can highlight real trends. Used to distract, they can mislead. That's why rules exist. You can't give a non-GAAP number more prominence than the GAAP one, and you have to reconcile the two. The SEC has made clear it's paying attention. When a company leans hard on adjusted numbers, that's your cue to ask what's being adjusted away. Think about the last earnings headline you saw. Was it a GAAP number or a flattering version of one? Every one of these standards exists for the same reason, to make the numbers tell the truth. You don't have to memorize them today. Pick one that hits closest to your work and go a level deeper this week. Because the professionals who really understand the rules are the ones clients and regulators trust. There's a lot more where this came from.